Hello. We're going to look at chapter 14 today, and chapter 14 is about long-term liabilities primarily. It's about financing your corporation, and we do that two different ways. You can do that through your long-term liabilities, or you can do that through equity. That will be chapter 15 when we get into the equity and common stock, preferred stock side of things, when we use equity to finance our company. This chapter is about our long-term liabilities, which is chapter 14. We're going to look at things like notes payable, mortgage payable, what they call term loans or installment loans. Also bonds payable, which can be somewhat difficult for students, but I'll try to simplify that as much as possible as we go through this. We're going to learn how to amortize what's called a discount on bonds payable or a premium on bonds payable, not through the straight line method that you would have learned in 2020, but through a method called the effective rate of interest method, which we'll use for some other things in this course as well. Before we get into that, I want to share a screen here, a link, and it's out there in D2L in the content section, which is module 2. But let me share this 10-year treasury chart that is out there. It goes way back, looks like 1870, what the 10-year treasury that the government sells to investors for a 10-year note. Kind of sort of like a 10-year CD, although in this particular case, you're talking about something that's government insured that they sell themselves and not where they're insuring the banks that are selling CDs. But look at these interest rates. You go back to the early 1980s, back when I was in college, I can remember that rather well. The 10-year treasury was up to about 15.5%. I can recall my mom and dad getting a CD when I was in college, and their CD was paying like 15%. Can you believe that? 15% for a one-year CD. Of course, the other side of that is, if you were borrowing money at the time, that was a killer. If you were looking at getting a home loan or what have you, or businesses were trying to expand, that was a difficult time for our country. In fact, you can go back to the mid-1960s, and you can see that the interest rates really took off. And during that particular time period, the stock market pretty much went down, and from late 60s till summer 1982, the market pretty much stayed the same place. But we know since then what has happened. Interest rates have been on the decline all the way down, and we thought it had bottomed out 4 years ago in 2016 when it hit 1.37%. Kind of bounced up into back in 2018 to close to 3%. At the time, they thought it was going higher, but fooled everybody, didn't it? All the so-called experts missed it, and it's all the way down to 0.68%. Of course, we know a lot of that is because of this pandemic. But the interest rates have fallen quite a bit to under 2% prior to the pandemic that occurred and caused the Federal Reserve to lower interest rates. So that's where we are as of Friday, 0.68%, or maybe Thursday. So what does that mean when we look at this chapter? Well, it's good to understand what's going on in the economy with interest rates. And when a company sells bonds, like let's just go back to this time here in 1981, a company was selling bonds to investors and paying maybe 15–16% for a 5-year bond. What happens to the value of that bond later? Like, let's say 5 years down the road, they were authorized to issue the bonds, but they didn't issue all the bonds until sometime later. Well, those bonds have a face value and a face rate. That doesn't change. Well, if the interest rates fall to 10% in the market and you've got bonds you're selling for 15%, what's the value of those bonds going to be when we sell those bonds? Bonds are going to generate much higher volume, or much higher, well, volume as well, much higher cash than what's stated on the bond. So a $100,000 face value bond may in fact be worth $120,000, because if I'm paying 15%, you as an investor, and you can go down and buy these new bonds from someone that's the market rate's 10%. Are you not willing to pay more for a 15% bond than one that you're only going to get 10%? And the answer is yes. And how do you calculate what that value is? It's not just what two people agree to, it's based on present value, which we'll look at in this chapter, which I know you've already had in 3010, but we're going to look at present value here as well. Present value of those cash flow interest payments, but also the cash flow present value of the actual principal payment that I have to pay back at the end of the period. Those bondholders, if they buy $100,000 from me, and that $100,000 I get, or $120,000 if that's what I get, I pay back the face value of those bonds at the end. You want your interest payment and you want your bond payment back, right? It's just like a CD. You want your whatever money you put into the CD, you want that back as well as the interest. Very similar. I just want to point out, as time goes on, from early 80s all the way down here, with interest rates going down, what does that do to the value of the bond? And the answer is the value of the bond goes up. Because if you're paying a lower rate in the market than what your bonds are stated at, you're going to get more money from it. And it's the same way if you're an investor in a mutual fund that holds bonds. Now, the opposite happened here over this time period. If you go back to really post-World War II in the early 50s, when you had the economy really taking off, and even though the economy was taking off in the 50s up through the mid-60s, interest rates were going up, but interest rates were low. But during this time period, if you were invested in bonds, if you sold those bonds before they matured, you would actually lose value. I just want to point that out, sort of tie in what you're learning in economics and finance with what we have here in intermediate or financial 2 accounting. Let's see here. Go back to, well, I guess I'm where I need to be. Let's see here. There we go. All right, so hopefully you can see the slides here for chapter 14. Here we go. Chapter 14, financing liabilities, long-term liabilities. So we're choosing to take on, companies are choosing to take on more debt in order to finance their business model. All companies do it. Google does it. Facebook, all these companies have debt and they have equity. And they have to balance that. They have debt covenants and so forth that you can't have so much, you can only have so much debt on your books relative to your corporation. It's very complicated, but here as accountants, we just want to make sure we can record these journal entries in this intermediate level of accounting, record these journal entries for the transactions that are going on in our business. So here we're concerned about how are we going to put this debt on our books, because we're going to what? We're going to debit cash, we're going to credit the liability, whether it's notes payable, bonds payable, installment loan, which is like a mortgage payable, all those are credits. So always keep the big picture in mind when we look at these chapters. All right, so we're first going to look at notes payable. Very straightforward here. What are notes payable? Usually similar to accounts payable, but with notes payable, there's interest involved with this, interest rates or interest payments involved with that. With accounts payable, there is not. So how do we make those transactions? Very simple. We're going to debit cash. We're going to credit, in this case, short-term notes payable, because it's a 6-month note. And you know that anything that's less than 1 year is considered short-term or current. So short-term note payable, if it was a note payable due more than a year, then you would have both a long-term liability, notes payable, and you would have a short-term, whatever's due in the coming year. Always important to keep that straight so all your financial ratios are accurate. Of course, as we get to the end of each of these periods. And I know for purposes of making this simple, Pearson, Wiley, all of these textbooks like to look at this as annual reporting periods, when in reality companies close their books on a monthly basis. But here we have at the end of the fiscal year, as of December 31, 2 months interest. So we have to recognize that 2 months interest as interest expense there at the bottom of the page, and interest payable, 1,000. Because that interest payable of 1,000 was what we had to accrue at the end of the year, and then we reversed that entry for interest payable and record the other two months there for interest expense. All right, and then there's our short-term notes payable, and so there's the entire cash that we have to pay out. You don't have to pay cash out at the end of the year, but you do have to do the accrual. We're under the accrual basis of accounting, right? The matching principle, very important. Match those expenses, even though you don't have to actually pay it till later. So the monthly interest is $500, 2 months is 1,000, right? And then we have $2,000 interest in the new fiscal year. So there's 4 months, 2 months and 4 months. It's 6 months total. Very good example there. That's really a 2010 or 2020 question. Term loans. What's a term loan? Here we have an installment loan, requires a fixed payment each. I can't see that for my face. Each period includes both principal and interest. Always an amortization table. When they say installment loan, they're talking about a mortgage payable. I know a lot of you have probably heard your parents talk about mortgages. Maybe some of you have mortgages yourself. But if you recall, when you're looking at an amortization of mortgage payable, you're making the same payment every month for 15 years or 30 years or whatever it might be, but the interest expense and the principal change every time. All right, if it's a 15-year loan, that's what, 180 payments. All 180 payments are the same amount coming out of your cash, but principal and interest change. You're paying more interest at the beginning, aren't you? As you get toward the end, you're paying more principal. Not quite as radical as it used to be, since interest rates are so low, maybe getting a 3% home loan or 3.5%. But my gosh, back in the days when interest rates were home loans, it's not been that long, or 8, 9, 10%. It's a big difference. All right, so here's an example. Since this is an online class, what you're watching here, won't be using the tables. You know, when the present value tables, the present value tables will be there in Pearson. And I would encourage you to understand how to use the tables to calculate present value. But in reality, what you're doing here on the exams, since the exams will be online, more than likely, you need to know how to use Excel to calculate this. It's more accurate than the tables are because the tables round off. When you work those Pearson exercises, unless you use Excel, you will get an answer that's a few dollars off, and Pearson won't count it correctly or count it as being correct unless you use Excel. Sort of interesting that they give you the tables, and using the tables doesn't give you an answer that Pearson finds acceptable, but that's just the nature of how Pearson's put that together. So anyway, Excel, they're using this function, payment function. You can see it right there in the center of your page, right here, if my pen works. Equal PMT, what's 0.04? That's the interest rate. 6 is the number of periods. So this is what? It's a three-year note, 8%, makes payment every 6 months. So that's why you see the interest rate is 4 and not 8%. You want 4% every 6 months. All right, and the period is not 6 years, it's 3 years. But it's 3 years, 2 payments a year, so it's 6 payments. N is equal to 6. All right, and then we have what, $250,000. So the question is, what is my payment, PMT, what's my payment going to be based on that? And the answer is $47,690. All right, let's look at the next page here. I can clear all these off now. You probably can't see the me deleting that, but that's something I have to do. All right, leave my face out of the way again. So there's my payment. This column right here, total payment. It's the same every time. That's what you expect when you have a mortgage payable. Again, mortgage payable, installment loan, it's the same thing. The interest payment is just going to be what? Every 6 months is 4%, or you can multiply 8% by your balance, and then what? Divide by 2. But 4% times 250,000 is 10,000. We already know what the payment is. Excel told us. So the difference is what? My principal reduction. And so there's my new balance, 212,310 times 4% gives me a new interest expense. So interest expense is going down every time, and what's happening to my principal? It's going up each term. So that's a 3-year, 6-payment installment loan. There's the initial entry. You debit cash because you're receiving this cash here as an installment loan. If this was a mortgage payable, like for a building or land or whatever, that cash would be what? It would be an asset like building or land. Of course, you got to break those out separately since land is not depreciated, but the building is. But that would be the difference in the debit. The long-term notes payable or mortgage payable is what goes on your books as a long-term liability, except for what you're going to have to pay down on that in the coming 12 months. There's my actual payments there for the first 2 periods. Interest expense, long-term note payable reduction, and then the cash. Cash is always the same. Love this screen because what they do, they're using T accounts. If you are not using T accounts yet, I know I've said that a lot already, you got to use T accounts to understand this. I was controller and director of finance in a lot of high-level jobs in my career, and I never got away from using T accounts. And most people will tell you that they still use T accounts to understand what's going on in graph form. So what you see here, of course, it's the general journal up at the top, but look at the T account down here. You start out with a $250,000 credit balance, right? And then each of those payments that you're making, you're reducing that liability on your books. And that's the principal payment, the principal coming out of your liability. Very important. All right, Pearson does a great job of showing the general journal and the postings to the general ledger being represented by T accounts. T accounts, so important. All right, so I throw in that word mortgage payable there. That's my own to describe this term loan. All right, so now we get into bonds payable. We talked about notes payable. We've talked about installment loans, including mortgage payable. But now we're going to look at bonds payable. Bonds payable. I've touched on that talking about interest rates. But bond payable is something that students really struggle with. I think after they leave my class, I think a lot of the students really have a much better grasp, because there are some things you can remember as you go through here that makes it easier than you think. You know, a lot of professors will joke about bonds payable, how difficult it is, because even professors don't like to teach it. It's probably one area that I didn't spend a lot of my career in, is bonds payable. And I did a lot of this stuff through my career because I worked for more than 30 years in various corporate jobs and plant jobs, as far as in accounting, operational accounting, financial accounting, cost accounting. But bonds payable is not one that I spend any time in, but I've studied it so much in teaching intermediate for the last 6 years that I feel like I've become somewhat of an expert in bonds payable, maybe know it better now than some of the other things I did for years. So if I can learn it, you can learn it. So, but bonds payable, that's when I have, me as a company, I need to raise cash for my business model. And again, Google just had like $1 billion issue a couple of years ago for bonds payable. So they're selling their bonds, and what that is, it has a face value. It has an interest rate and a maturity date. And that face value on that bond And that interest rate that is on there, that's what you are going to be paying as a company to whoever buys your bonds. It doesn't matter what the interest rates are later on. You're going to pay that from day one until the bonds mature, or you call them in early if they are callable. So you're going to pay that based on that face rate or stated rate and what the bond denomination is. Now, the question is, that I was talking about earlier about, is it a premium or is it a discount or do you sell it at par? Depends on the interest rates that have changed from the time that these bonds were printed up. And that changes daily a little bit, but even just a little bit can make a big difference. So if I've got bonds and I'm going to pay 5% face value on $100,000, that's what, $5,000 a year, and interest rates go to 10%, nobody's going to buy my bond for $100,000. If I'm only paying 5% and the market's paying 10, you're going to go to somebody else that has just issued bonds. And those bonds that I still have that I haven't sold yet, I'm just going to have to discount those bonds, right? That $100,000, I may only get $90,000 for them. The present value of that interest payments that I'm going to make and the present value of that actual payback of that bond, the face value, that has to be calculated to determine what the true cash value is for me and for the investor that's going to buy those bonds. So I'm the what? I'm the debtor, as it says here in the middle, whoever's issuing the bonds, and the purchaser of the bond is the creditor. They're the ones that are creditors that own these bonds. But this is just an instrument, a debt instrument that companies sell to people, whoever it might be. Talk a little bit about credit ratings here. The better the credit rating, the easier it is to issue debt. And the better your credit rating is, what? The lower the interest rates you can charge. Now, think about, you've heard the term junk bonds before in your finance classes. Junk bonds are bonds that the company may or may not make it. And because of that, those interest rates are going to be much, much higher than what a company that has a very good credit rating. So you can take a very solid company like Google or Facebook, very solid company, they can sell bonds with a much lower interest rate than a company that's filed Chapter 11 numerous times, like an Exide where I work. They filed Chapter 11, I think, 3 times now. I think the last one was they filed in 2002 when I was there, and then they filed again in 2013. And I think they filed again here about a month ago. Not sure they will make it this time, but you can imagine what kind of interest rates they have to pay bondholders. Very high. And that's because of the credit ratings. A lot of different types of bonds: secured bonds, debenture bonds, serial bonds, term bonds. I'm not into asking you to list types of bonds and stuff on exams. I'm more about you learning how the mechanics of making journal entries that impact your financial statements. But you do need to understand what these are, especially those last 3, because that's probably the more important parts of this chapter when we talk about types of bonds. Callable bond. What is a callable bond? That's a bond that a company can call in if interest rates fall. Now, if I'm paying 5% on bonds and interest rates continue to fall like they've done the last year or so, I can call those bonds in if they're designated as callable. I can call those bonds in and stop paying a high interest rate. And I can, of course, turn around and start issuing bonds again at a lower rate. That happens. But that's what you do. You issue callable bonds in order that if interest rates fall, you can call those in. Now, if interest rates start going up, you don't want to do that. All right, convertible bonds. Bondholders may convert into capital stock. That's also a common type of bond. And then we also have bonds that have stock warrants attached. Stock warrants. Stock warrants are equity. And these stock warrants can be sold as what's called detachable or attached. Meaning if they're detachable, we can separate those warrants out and sell those. And I say we, the investor, can separate those out and sell those. So me as a company that sells bonds with warrants, if they're detachable, I have to value both of those on my books, because whoever is buying those bonds with detachable warrants, stock warrants, to purchase stock, it's a hybrid since those can be broken out, I have to value those on my books at the date that I sell those bonds with detachable warrants. Now, if the warrants can't be detached, no problem. You just value this cash to the bonds only because they're not detachable. All right, so what does a bond look like, a bond indenture? Well, there's a face value, there's a stated interest rate, also known as nominal, coupon, or face rate. You know, that's the great thing about accounting. You have like 5 names for everything. It's the same thing. Same way with the stated interest rate. But the face value on the bonds, whether it's $1,000, stated rate, that tells you how you're going to calculate your interest payment to your bond holder, to your creditors, you as a debtor at the company, we as accountants. The interest payment period, what's the frequency? Is it quarterly, semi-annually, is it annually? I think most of these exercises are semi-annual, so it's twice a year. You gotta make sure you get that right when you start doing present value. Saw that in that present value calculation there on that payment for the mortgage payable just a few minutes ago. And of course, the maturity date, how long of a term is this? Is it 3 years, is it 5 years, 10 year? And of course, that with the interest payment period dictates what N is equal to. All right, great little chart here. Stated rate is equal to the market rate, meaning what's stated on my bond. If I have a bond stated like this, that stated rate is equal to the market rate, meaning what's the market, has it changed from the time those bonds were issued, meaning, or authorized, not necessarily issued. If that hasn't changed, then you don't have a discount, you don't have a premium. So you don't have to worry about amortization. That's easy, right? But if the stated rate on your bonds are greater than the market, less than the market rate, then you're going to have to discount those bonds. And the opposite is true. If the stated rate on my bonds, again, if the stated rate is greater than the market rate, everybody's going to want my bonds because they want a higher rate of interest, right? So I'm going to issue those bonds at a premium. Again, this is calculated through present value. Oftentimes bonds are quoted as a percentage of par value. Like what's 101%? That tells you it's a premium, doesn't it? 101%? What's 101% of a $1,000 face value bond? 101%, what is that, $1,010? Yeah, or 99%, what's the 99%? That tells you it's a discount. 99% of par value. So 99% of a $1,000 bond is $990, I believe. Sometimes it's quoted like that. All right, so let's get into the detail now that we've got the basics. What we have here is, move my face around. You can't see it, but I can. Here we have Ruffin Corporation has $40,000 par value, 4% for your bonds. So right off the bat, you see 4% of $40,000 is going to be the interest payment that I have to make. 4-year bonds mature on December 31, 2019, paying interest quarterly, right? 4 times a year. March, June, September, December 31st, fiscal year in December 30th. What is the issue price of the bond, assuming the market rate of interest is 4%? And the issue price is going to be at par, right? That's very simple. $40,000. There is no discount. There is no premium because the market rate is equal to the stated rate. Interest expense, you can see there is $400 every 6 months. $1,600 a year, right? 4% of $40,000 is $1,600 in a year, but it's $40,000 every 3 months. All right, and then at the end of the term, there's the actual debit bonds payable. Get it off your books and pay back the cash that they gave you. So that's a very simple, straightforward bond payable where stated rate of interest is the same as the market rate of interest. All right, now we're going to get into discount and premium. We have to use in 30/20, we have to learn how to use what's called the effective rate of interest method. Very important. In 2020, we focus on using the straight line method to amortize because we have to amortize that difference from day one until maturity. Because at the end of maturity, what am I paying back as a company? I'm paying back the face value of those bonds, regardless of how much cash I've got. I'm paying back the face value of that bond to the bondholder. Sometimes people get a mental block on that. But remember, I'm calculating my interest payment, my cash payment to my bondholders based on the stated rate of interest times the face value or maturity value of my bonds. And the difference between the initial cash that I get and the bond payable that goes on my books, always, the bond payable is at face value. That has to be amortized to zero. And the question is, do I do it through the straight line method or do I do it through the effective rate of interest method? GAAP says that there's not a material difference, which is significance. If there's not a material difference between the actual amortization between a straight line and an effective rate of interest method, you can use straight line. But in reality, using Excel and all these various software packages, we use the effective rate of interest method to do the amortization, just so we make sure everything is good. Because what's material for one company may not be material to another. That's one of those 5 principles, right, that you're supposed to be learning about, that you probably should have a pretty good grasp on already, since you've already taken 9 hours, at least 9 hours of accounting, 6 in principles and 3 in 30-10. Revenue recognition, matching, consistency, conservatism, and materiality. Very important. All right, effective rate of interest method. So here we've got an example. Issue $40,000, 4% bonds, same thing as we saw in that other example. Paying interest semi-annually, they've changed that to twice a year. Fiscal year is on December 31, but the market rate of interest is 2%. That says that Joel Fadley Incorporated, or Ruff Incorporation here, is their bonds are going to pay 4% of $40,000. That's $1,600 a year, $800 every 6 months. But if you go down the hallway to Taylor Stevenson Incorporated, and he's offering bonds that are paying 2%. Do you want Taylor Stevenson bonds or do you want Joel Fadley's Ruff Incorporation bonds? Well, you want Joel Fadley's 4%, don't you? Unless, what? Unless we find out that the value is going to be different. The market rate's 2%, 4%. You're really going to want mine, but I'm going to charge you, I'm going to get more cash for that. The present value tells me I'm going to receive more cash because of the present value. Now, the present value makes everything even. It's going to make it to where you're indifferent about whether you go to Taylor Stevenson for 2% or because you can get his bonds for $40,000 at 2%. But you may have to pay, well, we'll find out here shortly, $45,000 for my bonds. But yet you're going to get higher interest payments over that period. So over time, that's what the present value does. It tells you what makes this equal, right? That's what we're doing. So it is going to be a premium. All right, so we plugged that in, and there they stated it rather well in the solution here. You know, they've got the interest payment down here at the bottom. That's what we know we have to pay out in cash. But the rest of this is what we're going to have to look up. We're going to have to look up what is this $40,000 and what is this $800 discounted at, not 4%, 2%. All right. All right, so we plug that in. N is equal to 8. It's 4 years. Payments are twice a year, so that's 8, right? N is equal to 8. That 2% market rate is 1% every 6 months. That's why you see a 1% there. My payment, $800. It doesn't matter if you put a negative or not, but $800 every 6 months. And the future value, $40,000, I've got to not only do present value of an annuity, but I have to do present value of a lump sum if you were using the tables, which would be tables 2 and tables 4, and what you see in Pearson. So I plug that in, and that says I should get $43,061 from you, and you're going to get 4% interest payments for those 4 years every 6 months. If you went to Taylor Stevenson Incorporated, who is what? Paying 2%, yeah, you're going to get half the interest, but you only have to pay $40,000 to get that 2%. So think about it, $43,061, right? It's what you have to pay me to get 4%, or would you rather only pay $40,000 to Taylor Stevenson and only get 2%? Well, the answer is it doesn't matter. It's the same. But we have, as accountants, we have to record this on our books as such. And so there's the journal entry. We always debit cash and credit our liability. Always remember, bonds payable goes on your books at the face rate, always. Whether you're selling these bonds at par, you're selling them at a premium, or you're selling it at a discount. Bonds payable is always a face value, always. And so this premium on bonds payable or discount on bonds payable is the filler, all right? It's the plug number. It's what makes the difference between cash and bonds payable balance on your books as debits and credits. And so we have a balance there, and premium on bonds payable of $3,061. So now here's an amortization table for that. And what we see here, the carrying value, $43,061. Yes, that's the initial cash, but that's the carrying value. Don't lose sight of that. The carrying value is the right side of this entry. You add those two together because both of those are liabilities, right? They're both liabilities. That's on your books. That's the carrying value. It's like net book value when you have assets. Your property, plant, and equipment less accumulated depreciation gives you the book value or net book value. Net book value is the same thing here, or carrying value. Net book value and carrying value are the same thing in essence. Again, we like to use a lot of different terms to confuse you, right? Trying to make it straightforward. All right, so what we see here, $43,061. When I make that first payment to the bondholders on June 30th, I'm going to pay $800. I'm going to do that every 6 months. That's what you as an investor expect. But for me to record this on my books, the effective rate of interest says I'm going to take that market rate, which is 1%. Again, it's 2% a year, but every 6 months it's 1%. 2 divided by 2 is 1, right? 1%. So 1% of $43,061 is $431. My plug number is the amortization. So I'm calculating the effective interest expense. Right? I'm calculating that. I calculated this. So my plug number is always going to be the premium amortization or the discount amortization. Always remember that. You can't calculate this except by subtraction from what you've already recorded as your journal entry. That's calculated. That's calculated. That's my plug. And so 43,061 minus what? 369 gives me what? 42,692. That's my new balance for the next time. Then 427 is 1% of 42,692, right? See how easy that is? Delete all my arrows here, or check marks. There's my first journal entry for 6 months. Interest expense, we calculated, didn't we? Cash, we calculated. Premium on bonds payable. That's what it takes to make this thing balanced. Debits must equal credits. There's the next one. See, it changes every time. If it was straight line, like you learned in 2020, it's simple. You make one entry every time, 8 times in a row. But here, all 8 entries are going to be different. All right, then as you get to the end, bonds payable, your premium on bonds payable is gone. It's 0. And what's left is bonds payable, which gets zeroed out when you pay back the cash to your investors. Love this. There it is. Bonds payable. See, these are your liabilities, what this chapter is about. Bonds payable, credit balance from the beginning, nothing happens there. And whether it's a premium or a discount or a par, it's always the same, identical. Oh, here's what changes. Premium on bonds payable, see, 40,000 plus the 3,061 credit balances gives you the carrying value. There's my amortization. That's my plug number that I put in each time, which each time I get a different value, right, for what's my carrying value. But at the end, this has to be 0. So after all this has been amortized, after 8 times, 8 payments, 4 years, 0, all that's left is my bonds payable. See how clear that is? I think the fact that you've got T accounts for both is what makes it understandable, more so than just trying to think in your mind. I mean, these tables are okay like this. That's good. It's good to learn that. But at the same time, that's just another way to look at what you're doing here with your T accounts. Two ways to do the same thing. And I'm glad they're showing both ways. You know, it's funny, for a long time, a lot of textbooks back in the 90s were doing away with T accounts. They weren't focusing on that whatsoever. I guess they finally realized that's used in business, and it's made a strong comeback in all textbooks. All right, here's the same information, but this time, instead of 2%, 6%, right? So if I'm paying 4%, and now you've got Taylor Stevenson down here in economics, he's paying 6%. You want to go to Taylor Stevenson if it's the same $40,000, but it's not. That $40,000 has to be discounted by me through the present value to make Taylor Stevenson and Joel Fadley's Ruffin Corporation the same. Well, let's see what that looks like. They do a good job putting forth just stating the obvious, and they always calculate their payment down here at the bottom. The same payment, right? That didn't change. $800 every 6 months. What's the present value? So if we use Excel equal to PV, 3%, again, you're always using market value. You're not using the face rate to do this present value. Present value is at the market rate. Effective rate of interest. Market, same thing. Market rate of interest is the same thing as the effective rate of interest. 0.03, 8 periods, there's your 800, there's your 40,000. So what does that generate? 37,192. So you are willing to pay me 37,192 to only get 4% interest, when you could go to Taylor Stevenson and get him the full 40,000, but you're going to get what? 6% interest. See how that works? Makes sense? It's logical. All right, so there's my initial entry. You don't have a premium. You notice you got cash, you got your bonds payable, your plug number. Your plug number is your discount on bonds payable. That tells you if it's a discount, it has to be a debit balance. Premiums always have a credit balance, right? Which goes along with the bonds payable. Discount on bonds payable always has a debit balance, right? Same principle here. What you're doing, going through calculating your effective rate of interest. I won't belabor the point with the lecture longer than it needs to be, but again, there's your bonds payable. That looks identical, doesn't it? That's what we saw. It is. It is identical. And if I'm paying 4%, if the market had been 4%, that would still be the same. It doesn't change. You always put bonds payable on your books at face value. You'd be surprised how many people miss that on the exam. You should never, ever miss that. Ever. Or calculating what your interest payment is. But look over here. The discount on bonds payable has a debit balance, because this debit balance with this gives you that, what, 37,000, whatever it was. And then as we amortize this, we're crediting this discount on bonds payable to get that to zero by the end. So again, after 4 years, 8 payments, the only thing left on my books is the bonds payable. Through the effective rate of interest method, I have eliminated my discount on bonds payable. And again, when I talk about what we did in 2020, what you would have done there, you would have divided that by 8, and every period had the same amortization for that. And in that case, you're calculating the discount, and the interest expense would be your plug number, right? Under the straight line method. Okay, bonds payable. Illustrate accounting for bonds payable between interest payment dates. I'm going to skip that. There is so much to cover in this text from chapter 11 through 22. We just don't have time to spend on that. It does happen. If you understand what I've just gone through, you've got a pretty good grasp on bonds payable, and you're doing better than most students. Again, it's something I've had to learn because I don't have much experience in bonds payable. I have a lot of experience, but not in bonds payable. But I've studied it enough now to where I feel like I'm an expert. When I finally figured out it's not as difficult as people make it out to be, because it really isn't. All right, so issuing bonds is not cheap. Issuing stock is not cheap. There are costs associated with that. Legal fees, SEC reporting, all of this stuff, accountants, auditors, and associated with bonds is bond issue costs. Now, this, if you read the textbook, which I hope you do, the textbook is out of date. You say, well, why don't we change textbooks? Because all textbooks are out of date. We just changed this textbook a couple of years ago. And even when we looked at changing again, it still got the same principles because accounting is always changing some of these things just a little bit. This is one that's changed. What has changed, I've got in red there. This has been changed from a asset, the bond issue costs, gathering all these costs associated, instead of expensing it, you know, assets are debit balances, expenses are debit balance. Instead of expensing it, it used to be, and the text tells you that you should make an asset and then amortize that straight line over the life of the bonds or maturity or the service period of the bonds. Now, the only thing that changed, really changed the account title and moved it to the right side of the balance sheet, meaning as a liability, it still has a debit balance. But if it's got a debit balance as a liability, what is it doing? It's reducing your liability. So that's the only thing that changed. It's changed to a contra liability. And a contra liability just says it's got the opposite balance of what a liability has. If a liability has, they all have credit balances, then this has a debit balance. So you really just move the asset across the equal sign, and you're still doing the same thing. So that's just something that's changed. But I wanted to point that out. Bond issue costs, and there you see it. They had bond issue cost of $2,400. Now the cash, the discount, the bonds payable, that's what we just learned. Unamortized bond issue costs, that just reduces the actual bonds payable, doesn't it? But we're going to amortize that just like we're going to amortize the discount over its life. The discount on bonds payable through the effective rate of interest method, the bond issue cost, we just straight line it. Take 2,400 and divide by 4 years or 8 times, that'd be what, $300 every 6 months? All right, so there's my interest expense, there's the cash, discount on bonds payable. That's the same entry that we just learned. And then down here at the bottom, there's my $300, straight line. Reduce that liability by $300. Again, the text, what you're looking at here, acts like this is an asset, but again, you probably don't even change the account title. It's just been moved from your asset to the liability. And so what you're seeing here applies because it really didn't change anything other than we've taken an account title or an account and made it a liability instead of an asset. Changes your ratios a little bit, doesn't it? But not much. I mean, it's not material. All right. And there where I state that changed December 31, 2015. Hard to believe that'll be 5 years here in December. It's no longer an asset, it's a liability now. Early retirement of bonds. I think I may have an exercise in Pearson on that will work in the homework video. So I don't want to belabor the point by having a longer lecture than necessary. Try to keep them under an hour. Of course, you've always had gains or losses. You know, whenever if you extinguish the debt early, meaning they're callable bonds, you extinguish that debt early, you have a balance in your premium or your discount, right? Your bonds payable doesn't change, but when you extinguish that, you have to debit bonds payable, you have to debit premium or credit the discount to get it off your books. You got to clean your books up, get it off your balance sheet, and then whatever dollar value you're going to pay people for turning it in there, because they're usually what's called a sweetener, enticement to get them to do that, whether it's voluntary or not. You usually pay them something extra for the fact that you've called these bonds in early, because if you've called them in because interest rates have gone down, is the only reason you would call them in, not because interest rates go up. If interest rates have gone down, you would call those in. But you want to clean up your books, and the difference between cleaning up your books on those liabilities and the cash going out, well, the plug number is going to be whether, if you got to make a credit entry, it's a gain, right? If you got to make a debit entry, it's got to be a loss that goes to your income statement. So that's the gain or loss that's going to be calculated when we're trying to figure this out. Plug number. Convertible bonds. These are bonds that can be converted into stock, and companies do that for several reasons. They talk about it being a hybrid security, but convertible bonds means that an individual who buys these bonds, they can convert that to stock. Now, why do companies do that? Well, it says right there, without me reading the PowerPoint, way to raise equity capital when equity prices are temporarily depressed. You don't want to sell your stock when the stock price is low. When you have to sell a certain amount, I guess, when you first have an issue. I remember when Google went public back in 2004, Google stock sold for $99, I think, the first day, around $100, and I think it settled like $99. And of course, it's just gone out of sight since. Not like an Amazon, but it's gone out of sight to where I think Google is $2,000. Of course, you had a stock split in there as well, but they also like to sell that stock as a company at $2,000 and not $100. But that's the reason they sold stock, was to raise cash to fund their business. Of course, they sell bonds as well, but companies have convertible bonds when they don't want to sell their stock because they're selling ownership in their company with stock at a low price. They want to sell it at a high price, don't they? Of course, it's probably at a high price because they're doing so well, and then they probably don't even need the cash. All right. Convertible debt, convertible bonds are debt. Even though it could be converted, it is debt. When we get to the diluted earnings per share chapter, when we start talking about earnings per share, we have to take into consideration securities, bonds, primarily bonds and preferred stock that could be converted to, if it's convertible, it could be converted to common shares. That's where we have diluted earnings per share, but we'll worry about that here on the next exam. But that's this will make more sense when you get to that. There's an example of cash, bonds payable, and premium on bonds payable, that it was issued just like any bonds would be. And then when that was actually retired, the premium looks like it'd been cut in half just about. They tell you it's $37,722. That's the balance of my premium on bonds payable on my books. You got to get bonds payable out, got to get premium on bonds payable out, zero out liabilities, and then you put it to your common shares. The plug number on this is going to be your paid-in capital, right? So that 15,000 is the calculation of how many shares was this converted into times the par value. That's a calculation. So clean up your books with that. Clean up your books, your liabilities to zero. 15,000 is calculated, so that leaves you this additional paid-in capital is my plug number. So that's pretty straightforward, pretty simple, isn't it? I can see everybody shaking their head, right? The advantage of watching videos like this is if you're sitting in a classroom listening to someone lecture like me, unless you're recording it, and nobody does, if it's audible, but seeing what's being shown here and recording it, I mean, you could stop, go back, listen to it again till you really understand what's going on. I know last semester when I put the last half of 3020 out there on the web for students, because we went to completely online in the middle of the semester, the SAIs, a lot of students preferred that method, that of course they didn't have to come to class at a certain time. They could watch this over and over whenever it's convenient for them. If they're a morning person, watch it in the morning. If they like to watch it at midnight or 3 a.m., they can do that, or at work or wherever it might be. So a lot of students really like the asynchronous type meetings that we've been having, and that you obviously are in right now. All right, getting down to the last part of this on warrants. Talked a little bit about that at the beginning. These warrants, stock warrants, It is for purchasing stock, and they can either be attached or detached from the bonds, but they're sold with those. If they are detachable, meaning they can be sold separately as two different securities, you can sell the bonds, you can sell the warrants, then we have to account for that and give a value to each of those. And that gets a little bit complex in how we do that. But if they're not detachable, you don't have to worry about it. You just put it on your books along with the bonds, and it's just understood that there's warrants with that. So if these warrants are detachable, second bullet point here, you have two methods. We either use the proportional method or we use the incremental method. Proportional means we use proportional whenever both the bonds and the warrants or securities very similar to those are currently being sold in the market or traded in the market. And so there's a fair value associated with that you can calculate the new issue in allocating the cash proceeds from the sale to that. Now, if you know the value of the bonds but not the warrants, or if you know the value of the warrants but not the bonds, then you have to use what's called the incremental method, meaning the one that you know the value of, you value that one, and then the rest of it gets thrown into, I guess, the leftovers into the other security. So that's the two methods that you need to understand, and we'll see some exercises in Pearson on that as well. Let's go ahead and look at this, though, quickly. Here's CPW issued 2,000 of $1,000 par value bonds for $14.50. So they're telling you the cash proceeds, well, they calculated for you, $2.9 million. So the question is, I've got $2.9 million. Do I need to allocate that between bonds and warrants? And it says, well, each warrant provides the holder with the right to acquire one share of the company's par value stock for $25 a share. They have existing bonds outstanding that trade without warrants at $1,200. They're telling you the fair value of something trading right now. That's important. What is the journal entry record the issuance of the 2,000 bonds if the warrants are non-detachable? Well, if it's non-detachable, we could have just skipped the rest of that. If they're non-detachable, you don't do anything different. You just record it just as if what we've been doing the last 45 minutes to an hour. So there's my cash proceeds, $2.9 million. There's my bonds payable, 2,000 times $1,000 par, and then the rest is my premium on bonds payable, right, to make the thing balance. You didn't even talk about interest rates. You just know it's a premium because I've got to make a credit entry. Well, premiums are always credit entries. It boosts the actual bonds payable balance there to the cash proceeds. So that's easy. That's just like what we did. Then they say if the warrants are detachable, right? And we have a value for both of those. It says the warrants are trading at $25 each. The bonds are trading, or similar bonds are trading without warrants at $1,200. So we first have to calculate what's the fair value of what we're trying to allocate these proceeds to. Well, if I got 2,000 bonds and the market value of existing units, because 2,000 is the actual bonds that we are getting ready to put on our books, but we're using 1,200 is another issue that's out there already. It's not the 2,000 we're getting ready to allocate or sell. It's these bonds, however many there are, selling out there now at a similar market price or interest rate is $1,200. So that says the market value, the fair market value of what we're getting ready to sell is $2.4 million. The warrants, we've got 80,000 warrants associated with these 2,000 bonds, and similar warrants are selling for $25. So that's a current market value of $2 million. So we've got a total market value right now of $4.4 million. It has nothing to do with present value. This is just, if we sold these today, we would get $4.4 million for it. And so that gives us in that right column there, the proportion, right? The proportion of allocation. So 54.55% of the cash proceeds, right? Cash proceeds being 2.9 million. So that on the previous screen, and there it is, 2.9 million. So 2.9 million of that should go to the bonds, and or 54.55% of 2.9 million should go to the bonds, and 45.45% of 2.9 million should go to the warrants. So that's how we record that on our books. Now, the easy way to do that is put down what you know. Well, you know you got cash proceeds of 2.9 million. That was on the previous screen. Remember that? There's the 2.9 million. So we're just taking that 2.9 million and allocating them between warrants and bonds. There's my 2.9 million. Bonds payable is always at face value, right? We just calculated what the allocation to warrants are, 1,318,050. So then we can make this number our plug number. All right, that's a simple way to do it. We can calculate the discount here if we want to, but you don't have to. How do you calculate it? Well, they show you here. The $2 million, right, minus 1,581,950, which is allocated to the bonds. Face value minus the allocation to the bonds tells you that it's got to be 418,050. But you can use that. Simple way is to use that as your plug number. That's the proportional method. And that's necessary at times. Incremental method says, well, we know the value of one, but not the other. So in this particular case, it says that assume the warrants do not have a readily determinable fair value. Well, if we don't know what the value of the warrants are, then we're going to value the bonds, because we do have that, and value the bonds and then just plug everything else into the warrants. That's a plug number. So there's my same 2.9 million for cash. There's my bonds payable. And the premium on bonds payable must be 2.4, or the total cash proceeds must be 2.4 million, because we just calculated that these bonds are issued at a $400,000 premium. 2.4 million minus the, yeah. Well, that's the wrong way. 2.4 million is the market value. That we calculated in that previous screen. So if we know the bonds payable is 2 million, right, face value, then that must be 400,000. That's a plug number, right? And then we know this is our second plug number. You won't see that in any textbook. Plug number one, plug number two. I wish I didn't have to delete all of these. You can't see what I'm doing, but I'm going to delete everything I write on here. Exercising these warrants, the firm removes additional paid-in capital stock warrants, because that's what it's called, additional paid-in capital stock warrants. That's a capital account. That's not a liability. So that's going to be zeroed out, right? Credits to common stock for the par and credits the remainder to additional paid-in capital. The remainder to additional paid-in capital means plug number. And there it is. 2 million cash, additional paid-in capital stock warrants, common stock. There's the exercise. All right, one thing left in these PowerPoints that there's an exercise in Pearson on. It's very important. It's very basic, but it's very important. What about short-term debt reclassification? What happens there? This is interesting, because I never would have thought this would have been something that happened in business, but I found out when I got out of college that this actually does happen. And I'll give you an example. Let's just say that your books close on December 31, and you have just a few days to close your books, maybe 5 days. And at the time when you close your books, you have a difference between your short-term and your long-term liabilities based on what your knowledge was at that time. But if you get somewhere maybe in early February, which is more than a month after you conceivably close the books, and your auditors find that your financing arrangement changed, and this could be on a lot of things, not just financing, since we're talking about this chapter, but your auditors may very well say, well, now that you know that this has changed, you need to go back and adjust your financial statements for year end. I've seen that done on vacation for people who quit. Vacation accrual is something that we just did in chapter 13. Going back and changing your statements because someone took an early retirement or something and impact your vacation accrual. Well, if you have knowledge of that, even though you're beyond that date of year end, you need to change your statements. And that's what they're saying here in this particular section about short-term debt reclassification, is there's two reasons. If you intend to refinance on a long-term basis and you've got the ability to do this, then this is something that you need to make a journal entry for. They've got a great little example here, and I think this example is identical to the one that's in the homework. The numbers may be a little different, but the numbers should be different. But what's taking place here is sort of the scenario I just gave you. That $300,000 is being taken out of short-term notes payable at December 31, 2015, even though they're making this entry sometime in February, it looks like February 2nd, they're going to reclassify that $300,000 they thought was due at the end of December short term, but now it's going to be more than a year later, they're going to put it to long-term notes payable. And so that's an example of short-term to long-term notes payable. But making entries like that is not unusual, that auditors will have you do that. It's not a mistake that you make. It's just things change that you need to, as accurately as possible, reflect what your year-end statements are. So it's very clear. It's a very good exercise here on really reality of what takes place oftentimes in business. I think that is probably it for this chapter that I'm going to cover. We'll talk about fair value option later, in a later chapter, as far as what that means to use in accounting and learning. A lot of stuff in here, a lot of stuff to get through. 30/20 is, I would say, the most difficult class you'll encounter in your accounting major for the most part. All right, so let me stop the share of that, and thank you for paying attention. I will have another video for the homework that you can look at and work through. And always, please email me if you have questions, and I'll get back with you just as soon as possible. Thank you, and have a good day.